Hey, welcome everybody. Let's talk real estate. Your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California. As we take a no BS look at both sides of the issues driving this market today to find the best solutions going forward. With our man right in the middle, it's Barry Saywitz. Hey, Barry.
Hey, good morning, Paul, and good morning to all of our viewers and our listeners out there. Welcome back again. If it's Tuesday, we're talking real estate. I'm Barry Saywitz, president of the Saywitz Company and managing partner of Barry Saywitz Properties. And we're here again to talk some more real estate. I'm excited about today's show for a couple of reasons. Number one, this actually is the 1-year anniversary of us starting this show, so it's pretty exciting. I thought I'd have a cake or some candles waiting for me. That's not the case, but I may take the rest of the day off after 5 o'clock. I think that's my big thrill for today. But that's number one. Number two, I'm also excited that we're getting close to Halloween, and I get to go pick out my Halloween costume. So if you haven't done that already, I would suggest to do that as well. And the third reason is I'm excited to have our guest on the show, Jeff Cole, Executive Vice Chairman of Cushman and Wakefield. Today we're going to talk about the capital markets and Orange County and where it's been, where it is, and where we think and hope it's going. Jeff, welcome to the show. Thanks for coming on.
Thank you. I'm honored to be your 1-year anniversary guest.
Yes, it's exciting. We're going to give you a mug or something to take home. So you are the Executive Vice Chairman of Cushman and Wakefield. You have been in Orange County longer than I, and long history in watching the real estate market here. I'm going to call it grow up and really evolve into multiple different cycles, really. I want to take a history trip back for a second, but we were talking before. You started in Orange County in the late 80s. And watched and helped lease up and some of the bigger complexes that exist today get built and get filled up. And they're still around. And where has Orange County come in general in terms of the desirability of companies wanting to be located here?
Well, it really has changed in the last 35 plus years. I would say the biggest change is this market has really become internationally renowned as far as investors are concerned. From where it was in the 80s, it's really become I wouldn't say a go-to location related to, in respect to maybe other international cities, but it's certainly become a national destination for investors, particularly institutional investors, and that's really just come in the last 25 years. And it really has to do with really the lifestyle. I think the fact that it's the geographic center of Southern California and the growth that we've seen, instead of becoming a bedroom community of Los Angeles, which is what it kind of was back in the 80s, as you know, Barry, has really become basically its own destination for international headquartered companies, and certainly a diverse, we can go into a diverse scope of industries that are located here.
Yeah, I mean, look, I grew up in San Diego, and then I went to school in LA, and to me, Orange County was where I stopped to use the restroom halfway up and check out the orange groves. And today, I like the fact that geographically we're centered. You're an hour or plus or minus to San Diego, an hour plus or minus to LA, Inland Empire. On a plane, you're an hour to a lot of different places as well, whether it's Phoenix or Vegas or San Francisco. So it really is sort of a center, as you mentioned. And then I find that the dynamics of the businesses that are located here are really far more diverse. If you look at other parts of the country, you have the overflow from Los Angeles with the tech and the entertainment. You have overflow from San Francisco. You have overflow from San Diego with the biotech. And then you have CEOs that really want to live here. Right. So then they bring their companies and their employees with them. And so it's not just bricks and mortar type businesses. It's not manufacturing like you'd find in the Midwest, a majority, and it's not old school law firms and things like that that you might find in other places. And so it really is a dynamic environment, and then that translates to the kinds of commercial real estate product that people build and develop and modify as time goes on.
That's right.
So your team at Cushman and Wakefield, that's another example of how Orange County has grown. When I started and when you started, you had a lot of smaller brokerage companies and real estate companies here, and the big companies had offices in Los Angeles, and they'd just drive to Orange County, and people would complain about it, right? Even though there was no traffic then. They didn't like going. And now, there are major offices for major brokerage companies and real estate companies not headquartered, but based certainly in Orange
Sure.
County. And so your group within Cushman and Wakefield, which is a global company, one of the largest, handles the capital markets and larger investment transactions, I'm going to call it, with institutional buyers and sellers, in addition to local players as well, correct?
That's correct. I co-lead our capital markets group for the West Coast, and really I would say our primary client is an institutional client, but as you mentioned, there's a significant number of what we call private family office investors. Orange County particularly has a lot of high net worth individuals that have been active in commercial real estate, and so we represent those as well.
And in terms of the product that you guys deal with, it's really all products, is it not?
Cushman & Wakefield handles all products. We're have a global platform, as you mentioned, but our team primarily focuses on office and industrial real estate.
Yeah,
on the West Coast.
And types of size of transactions. This is not the $1 million, $2 million transactions.
No, we work on sizes from $10 million to $500 million. I think our average sales in the last couple of years have been about $50 million.
So big stuff.
Yeah.
So in terms of the commercial markets here in Orange County, I want to rewind a little bit for a second. And so you and I have both lived through the 80s, the 90s, the dot-com, the dot-bomb, the recession, all that fun stuff, where you watch the market go up and down, you watch people kill it and then starve it, and people get in and out of the business and all of that. And I feel like we're at the cusp of something, and I'm not sure what the something is going forward, because the market is certainly changing. And what was happening in the first quarter of this year compared to what is happening now, definitely a different story. Would you agree? Yes,
I think you mentioned being on the cusp. We certainly were talking about Orange County in general on the office. Let's start with the office side, because it's a completely different story on the industrial, if you like. But we were certainly on the cusp, I would say, of some significant growth in terms of rental rate growth and desirability, and just going into COVID. And interesting enough, Orange County hasn't really reacted as well as maybe some of our surrounding communities that historically have been placed in the same kind of position as North San Diego, for example, or West Los Angeles, where those markets had really, going into COVID, had really, this is an interesting story, had really exploded as far as demand and rental rate increases. We didn't really see that here, but we started to see it in 2018 and 19. And unfortunately, when COVID hit, we really hit a pause, and we really haven't come out of it yet, like some of those other communities have. I would argue that we are going to come out of that, and there's a catch-up that has to occur from a rental rate standpoint, and we haven't seen that, and that's, it's unfortunate that we have another, as you just mentioned, I would say, a challenge with these interest rate movements that we've just seen in the last 90, 120 days, and that's actually put a pause also on growth. And so my thesis is that we have a pent-up demand that's going to occur in this market sometime soon, and whether it's in the next 12 or 24 months, but it's something that's going to be, in our opinion, fairly dramatic, and a really spiking of demand and rents coming.
And it's interesting because people look at it now and they talk about the multifamily market, they talk about the industrial market, and office is always at the bottom of the list, right? It's just the struggler. At the same time, you've seen rents come down, but you haven't seen it to the point where people are completely desperate, where they're giving away the farm in terms of landlords or developers, or that prices have dropped dramatically. But I guess I'll ask the question, because I was reading an article this morning where they were talking about the lag between the office and industrial markets for investing in terms of cap rates relative to the rise in interest rates. And what this article was saying is that there's really a 6 to 12 month lag from when the rates shoot up until the market actually feels it and the pricing gets adjusted. I'm curious your thoughts on whether you see that that's the case, or whether it's an immediate impact of just pullback.
Well, in the office, let's talk about the office sector. I would say it's relatively, there is a lag, but I wouldn't say it's a long lag. We've already seen it. There's been what we see immediately when you see that interest rate movement is a pause. And so we've seen a lot of investors basically said, listen, we need to understand the impact of these interest rate movement on values. And so the transactions, we have a half a dozen, let's say, office transactions in the market at any given time. I would say a lot of those have paused, and some of them actually have, cap rates have immediately moved up in order to transact today. There's just so much uncertainty of where the future interest rates. I think the consensus is rates are going to continue to rise in this near future. So if you're a seller today and you want to transact, and investors are saying, listen, we're unsure of where this is going, and we therefore have to be more conservative in our underwriting, or just concerned about closing in this type of environment, we're going to require some type of adjustment. And I would say in the office sector, unfortunately, we're seeing that go on right now, and we're seeing, I would say, those cap rates rise. If you were asking me what the range of cap rates, depends on the transaction, but it would probably range from, in the last 90 days, probably a 50 to 100 bip rise in cap rates in that period of time. So pretty significant.
Yeah, significant in terms of the value, but also interesting that it's not really a 1-for-1 in terms of interest rate, right?
That's correct.
When interest rates were in the, I'm going to call it mid 3s to low 4s, if you rewind 6 months ago, you had cap rates in that 4 to 5% range, and so now you have interest rates which are in the 6s and going, and so you haven't really seen a 200 basis point increase in the cap rate. But it's also interesting that, especially on the office market, that the value of the building is dependent upon the rents, and so if I cannot raise the rents because the office market is struggling, then that also, to me, has just a global impact on the view of the office asset as a whole. And then the other thing, I'm curious your thoughts, but that is, I know from my own building, the cost of renovations is just through the roof, right? So you have supply chain issues where you actually can't get material, and then when you can, everything's more expensive. And so the cost to renovate an office building becomes much higher than an industrial building or something else.
Yeah, and that by definition is one of the reasons why office isn't as in demand as industrial product, is the cost of the capital, not just in tenant improvements, but just in capital improvements in general, improving a building today.
And so do you see, let's not call it next month or the following month, because I think the fourth quarter is going to be a real struggle. It normally slows down for our industry anyway. And I think you just have this volatility in the market. You have the promise of interest rates rising. It just can't help the cause as a whole between now and the end of the year. But into next year, over the next 12 months, do you see that as more people come back to work, that will help then the office markets try to dig out of where it's at today and improve?
Yeah, they're incrementally improving. As you mentioned, there has been a slower than expected, I think in many cases, back to office occupancy by companies in Orange County. In some cases actually slower than other communities, which is surprising, but maybe not. I think the argument about why maybe, for example, our research just came out, I think the end of the second quarter. At the end of the second quarter, I think the back to work percentage in Orange County for larger companies is still only about 50%. It's still very low, right? So that's been, but that is improving incrementally. To answer your question, I think the rental rates have to move up. I mean, they're at a point now, as you just mentioned, we've been in the business a long time, but if you remember the rents that we had back in the late 80s, the real rents today are actually, when you take out the expenses, are about the same, if you can believe it, 30 plus years
because the
later.
rents are a little bit higher, but the expenses are double what they used to be.
Exactly right, which is kind of hard to believe. But.
And it's also, too, I mean, when you watch the market and people go, well, what's the market? What are rents, right? It's an abstract term because it's different for every transaction. But also I watch concessions. And so the rent, if it's $2 or $2.50 a square foot for office space on a monthly basis, that doesn't tell the whole story, right? It is the amount of improvements that have to go in and whether there's any free rent or not. And you virtually had zero free rent at the beginning of COVID. And now you're starting to see people go, well, look, I'll give you some free rent because I'm not sure the end of the tunnel, right? And so I want to just get somebody in who will pay. That's
a good point. And the concession cost, you mentioned free rent, but going back to your improvement question too, the improvements for average tenant improvements today for an office building in Orange County at approximately $65 a foot. You remember when we were, where it was maybe $15 to $20 a foot not that long ago. So that's increased over the last 12 to 18 months, 25%. Just to give you how much increase.
Look, the air conditioning unit I bought last year was $6,000, and today it's $10,000, right? So that's just a micro of what's going on out there.
And that's causing a drag on values because your underwriting has to be all underwritten in how investors are looking at the long-term, appreciation value of an asset.
And so with your institutional clients, in terms of when they're buying these kinds of assets, it's big dollars, it's big money. They're fairly conservative types of investment entities. But what's a typical hold time for them, if there is one, or is everybody
institutions will still look at a 10-year hold? That's, I would say, that the groups that we work with, a pension fund advisor or REIT, or even insurance companies will look at, I would say, average 7 to 10 years. Private investors will sometimes take a shorter look, especially private investors that are more value oriented or opportunistic. And I would say that a lot of the groups that, you've been through some of these downturns that will buy office during a perceived downturn in the market will be buying basis, just per square foot, cost, and they'll be looking at it more as a 2, 3, 4 year return. So it depends on the investor.
Yeah, and I think there may be some of that opportunity over the course of the next 12 months.
Correct.
If there's continued adjustment in price, if there's continued increase in interest rate and cap rate, then somebody might jump in and say, hey, I think there's an opportunity. But the flip side of that is, in today's window, and you're living it every day, it's so much easier to go to a different asset class because you don't have all the struggles with it. So let's shift gears to the industrial side of it, which is compared to the office market, I'm going to just call it off the chart, right? And so you have values for industrial buildings higher than an office building, right? It's shocking to me that someone would buy a warehouse in Ontario for a higher price per square foot than an office building in Newport Beach.
Hard to believe, but it truly is a tale of two cities, an industrial office. Hard to believe that you mentioned that industrial values are significantly higher in some cases than office values, which we never would have thought, because the cost to build office space is still so much higher than to build industrial space. But it really goes back to the demand side. It's the drivers. What's driving industrial space has been for many years now is the big thing that you've heard about, of course, is e-commerce demand, and it was started by the Amazons of the world, particularly Amazon, and that really was a dynamic paradigm shift in the industrial market when that started happening. When the vacancy rates, for example, to compare office and industrial is just night and day. I think the industrial office vacancy here in Orange County is approaching high teens, 18 to 20%. Industrial vacancy in Orange County is 1%.
Right.
And in all the markets, in Inland Empire, which historically had a lot higher vacancy, is down to 1.5%, just under 2%. So we're just seeing historic low vacancies, and that's been primarily driven by the e-commerce demand, not just Amazon's, but the FedEx, UPS's, and all the other ancillary companies that are following suit. That is really trying to meet the consumer demand for product being delivered to these warehouses, being delivered in some cases in a couple hours. Some cases certainly overnight is now standard.
And you've got also this whole dynamic of the 3PL company, where you have smaller warehousing companies that it's just not cost effective for them to service their own needs or get their own warehouse, and so they go out and get somebody else to do it for them, and those guys gobble up big chunks of space and are, I don't want to say they're not concerned, but certainly less concerned about the rate because they're just passing it on to their clients. Mm-hmm. And so pre-COVID, to me, we watched that run up, especially around the port, and also in the Inland Empire. And then you look at the small guy who says, look, I've made some money, I've saved up some money, interest rates are low, this is going back. I'd like to buy a building. I'd like to control my own destiny. I'd like to be my own landlord. I'd like to build some wealth. And there's still, and there was, attractive financing through the SBA. The dilemma, and for a long time they were building small owner-user buildings that people could gobble up and own on their own. You don't see that anymore. Now it's all the big stuff.
Yeah, you don't see it because they're competing with these institutional investors that have just huge pockets of capital, and they're just driving pricing, in some cases, through the roof. I mean, the industrial rents in the trailing 12 months going up through August, have been over in a lot of the markets we just talked about, Orange County, South Bay, parts of Los Angeles, Inland Empire, have gone up over 20% a year over the last 2 to 3 years. It's just
right, and you have clients that are coming out. We do have clients that are coming out of 5-year-old leases. That it's really just a shell shocker in terms of the incremental increase in the rent, and that all goes right to the bottom line. Which I guess brings me to my next question, which is the industrial market. Hot. I don't know how else to describe it. Lots of capital chasing very few opportunities, and certainly you have very limited supply against still high demand. Does the supply-demand concept, for lack of a better word, trump what is going on with the rest of the economy? Because all the other things in the economy are a struggle. And so at some point, doesn't the cap rate on an industrial deal have to go up? And at some point, doesn't the rent have to flatten out because you just can't support it? Things don't go up forever, I guess is my point.
Well, for the first time in this cycle, because of interest rates and the concern, I would say investor sentiment has shifted, even in the industrial side, in the last 90 days due to, I would say, 3 things. You touched on them. Interest rate run up, geopolitical concerns is something that these institutions are sensitive to, and what's happened with Ukraine, and just general concern about going into a deeper recession. And then, of course, we haven't talked about is an impact of inflation. So those 3 things, and let's talk about inflation, have impacted already cap rates on industrial, even though we've been saying how strong the demand is. Rents are going up 20% a year. Inflation on these long-term, we're selling a lot of long-term single-tenant assets, industrial, including Amazon leased assets, FedEx, that might be 10, 12, 15, 20-year leases.
Right.
Those values have moved quite a bit for the first time in the cycle. Cap rates up for the first time in 10 plus years, because those leases, this is interesting, have rental rate bumps, as you know how these work, and annually rents that in these leases that are only going up 2.5% a year,
whereas inflation
is at 8, 9. And so investors are saying, listen, that I can't own a long-term lease with those kind of returns anymore. I won't catch up. I'm going to have negative.
So it impacts my value.
Impacts the value. So those cap rates on average have gone up 50, 75, 100 bips, depending on the building of the market. So that's the first change to answer your question.
It seems like that would apply to a triple net. I mean, the Amazons are triple net, but also just a Walgreens or a Rite Aid or some of these.
All those have been impacted. They've all been impacted, which is the counter to that, or where things are even in more demand now, are the short term roll to market, what we call roll to market leases that maybe expire 1, 2, 3 years. Or even what we call forward sales, when you're buying a building in advance of it being completed. Those are actually in bigger demand because the going back to the rental rate increases, the investor sees that as an opportunity because they can get to higher rents earlier, and so they can, in their, let's say, a 5, 7, 10-year hold period, they're going to be, it's going to be an attractive investment. For them.
I suffer with the low rent for the first couple of years,
yes,
but then I get
the big pop.
The
you get the big pop when the rents are rolled to market,
yeah.
Assuming that you believe that we're still going to have a real low vacancy and there's still going to be demand. You talked about demand maybe flattening. We haven't seen it yet. That's even with all the stuff going on with the economy. It's on the industrial side. We just have not seen that demand waiver, according to, there's still a significant amount of demand in almost all the markets we just mentioned, and we don't see that changing in the short run. Now, if we, short of going into a real black swan geopolitical event or a deeper recession,
nuclear war,
there's just
whatever, right?
There's just too much demand, and the demand by consumers is not going away, and there's more barriers to entry than ever in these infill markets. In the LA basin is the strongest industrial market in the United States, and there's just more and more barriers by municipalities, and that's another topic, but there's a lot of these municipalities recently are now putting moratoriums on new industrial development because they're concerned about these infill markets with all the impact with traffic to the trucks and vans that are coming in and out all 24 hours a day. So there are a lot of these cities now that are great industrial markets are even harder to develop, and so that's going to even create more demand.
Yeah, and that's probably a whole nother show. I told you it would go fast before we started, and we've only got a minute left. You and I could go all day. We'd need some more coffee and maybe some birthday cake or something. But we are, unfortunately, at the end of our time, and it is an ongoing, continually changing environment, and it'll be interesting to see. I'd love to have you come back in 6 months. We'll check and see where we stand and where we've come and where we're headed going forward. But I guess in closing, advice for sellers of office buildings in today's environment. Do I sell and do I adjust my price to get a sale done, or do I wait and see how it goes?
Well, it obviously depends, but in general, if you're an owner of a traditional office building, when I say multi-tenant, traditional building versus something that's more creative, campus style, because there's a different buyer for that, but I would argue that most of the property sellers own traditional office space. I would probably, we're recommending holding for a period of time. We're thinking you get unfairly penalized right now if you wanted to sell, because there's just no institutional buyer to take you out today. So you're only looking at what I would call those opportunistic private buyers today, and we think you're going to be unfairly penalized in price. If you can wait 6, 12, maybe more, when you're starting to see some of the green shoots. We didn't get to talk about what are the positive things going on with life science and some of the new demand going on here in Orange County, but I would probably say wait.
And on the industrial side, do I sell at the peak of the market, take my chips and go home, or is there more to come?
In most cases, I would say there's some significant demand. There's more chances of things going down than up. We'd be recommending almost anyone who wants to sell in the next couple of years to sell now.
Yeah, got it. All right, words of wisdom from Jeff Cole at Cushman and Wakefield. Thanks so much for coming and sharing your thoughts with us, and much continued success to you and your family and your team, and we'll look forward to see what happens here in the next several months, and appreciate you coming and talking with us.
It was a pleasure.
Yeah.
Thank you, Barry.
So for everybody out there, thanks again for tuning in. I am Barry Saywitz, president of the Saywitz Company, and if it's one thing I've learned in my 30-plus years of doing this, it is to look at both sides of the equation, surround yourself with experts, and try and make informed business decisions. Hopefully today has been a little bit helpful for those folks out there looking at the investing side of things. We thank you for tuning in. I want to give a thanks to all the folks here at OC Talk Radio, our producer, Paul, our announcer, and the whole rest of the team. Thanks for tuning in, and we'll see you again next week on Let's Talk Real Estate.
Well, there you have it. You've been listening to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current state of the real commercial real estate market right here in Southern California. On Orange County's only community radio station, OC Talk Radio, streaming live from our studio here at the University of California Irvine's Beale Applied Innovation Center.